Welcome to the Market Pulse podcast from Equifax, where we break down the latest economic and credit insights to help you navigate today's business landscape.
Hello, everybody, and welcome to this special edition of the Equifax Market Pulse podcast. I'm Wendy Hannah-Olson, Senior Vice President, Digital Alliances and Strategy Execution, and I'm delighted to be hosting today's conversation. We have a very bright mind joining us, Joni Baker, a mathematician and senior researcher on the behavioral modeling team of Andrew Davidson Company. Welcome, Joni.
Hi, thank you for having me.
Absolutely. Thanks for being here. Today, we're going to be diving into a topic that sits at the very heart of the American dream, the mortgage process and the role of credit reporting. Since the late 1990s, the TriMerge credit report, which pulls data from all three nationwide consumer credit reporting agencies, including Equifax, briefly known as the NCRAs or credit bureaus, has been the gold standard for determining who gets what loan at what price. But the ground is shifting. There has been much heated debate in the industry. Should we move away from the TriMerge standard in favor of a single or bi-merge credit report? A new white paper from Andrew Davidson Company called The Impact of Moving Away from the TriMerge Standard suggests that this move might come with hidden multi-billion-dollar costs. So let's dig in. So Joni, I'm going to start with the foundation. What was the study that you performed?
Okay, well, basically our study examined the credit score differences across the three NCRAs or bureaus, Equifax, TransUnion, and Experian. And again, I'm really excited to be here talking about it. I think this was the first time that a study like this was able to be performed on an unbiased, uncensored data set. And so I'm excited to share the analysis that we did. So first, we examined the raw underlying score differences between any two individual NCRA credit scores for the same consumer. So in other words, what does the collection of those differences look like across all possible credit score pairs and all consumers? So we're just looking at those raw differences. And then we considered various metrics that result from choosing or combining consumers' scores in different ways, representing either a dual or a single credit reporting standard. And we compared that against the current TriMerge standard for GSE mortgages, which is to take the median or the middle value of all three scores. And we did this across different assumptions, such as the scores are chosen randomly, or the outlier score is chosen, or the maximum score is chosen. And we also subdivided the consumers in different ways to see if these metrics varied for different populations. So I kind of like to put this study into context and explain why studying the differences between the bureaus is important, and describe a little more how credit scores are used for mortgage qualification and pricing.
I welcome that. Thanks, Joni.
Okay, great. I just think it might help people sort of, especially with some of the things that I suspect, I might want to talk about later on.
Yes.
So since 2008, the GSEs, Fannie and Freddie, have used a loan level pricing adjustment table, or LLPA table, to determine the risk-based fees when a mortgage is originated. And the fees vary for credit scores from 620, which was the traditional cutoff, up through 779 in 20-point increments. And the fees are also based on the loan to value for the mortgage. And if that loan to value is greater than 80, then the required mortgage insurance, or PMI, also varies. The cost of that insurance also varies based on credit score and LTV. And meanwhile, 620 has been the traditional hard cutoff for qualifying for a GSE mortgage. And while they have very recently moved away from a hard cutoff, for consumers in that general credit score range, the credit score, of course, will be a major deciding factor as to whether they qualify for the loan. So the question is, what credit score is used? And as we've said, it's been the TriMerge standard requirement. Pull all three credit reports from all three bureaus. And then for the consumer's representative credit score, use the median of those three scores. So the FHFA has previously considered relaxing this requirement to a bi-merge. And under that, the lender may pull just two reports and use the average of the two scores. More recently, it's been suggested that the GSEs could even move to a single report standard, in which case a consumer's score is based on just one of three sets of NCRA data. So basically, to understand the ramifications of such a move, it's important to study the score differences between the bureaus, and that's what we did.
Absolutely. And I know right at the beginning, you mentioned a little bit about which data was used, but I'd like to, for the audience, reiterate that. So can you explain exactly what data was used in your study?
Yeah, sure. So we had an anonymized sample of consumers for a snapshot from October 2023 that included, for each consumer, each of the three individual credit scores, based on each of those scores based on a single set of bureau data. And I should say that for the credit score model, we used Vantage Score 4 because this model is the same across all three bureaus. There aren't any inconsistencies between the scoring formulas. So what that means is that differences between the NCRA's scores generally reflect differences in the underlying data. We also had a flag indicating whether a consumer was low to moderate income, meaning that the household income was below 80% of the median family income in that metro area. And when available, we had another field indicating race or ethnicity information. And I should note that this information is not in a consumer's credit file, but was attached anonymously from a third party. And it's also important, again, to note, these weren't just consumers already holding GSE-backed mortgages or even having a mortgage at all. In fact, we had all consumers below 700 that had credit scores at all three bureaus. And we had a random 10% sample for consumers above 700. So each sampled consumer above 700 represented 10 consumers. And accounting for that rescaling of those above 700, there were almost 250 million consumers represented in this study data set.
That is a lot of data, 250 million. Thank you for that. So can you help us understand how much difference can scores be between the three NCRAs, since you had Vantage Score 4, which we know leverages the full breadth and depth of the three NCRAs plus the trended data. So it's additional alternative information within the credit reports. How different can the scores actually be between the three NCRAs?
Yeah, so that was the very first thing that we looked at. What are the raw score differences between any two given scores for a consumer when those scores are based on data from a single bureau? So just thinking like if you were to choose two reports randomly, how different are those two scores? And what we found was that the two scores were actually identical about 42% of the time. So that maybe sounds pretty good. However, 27% of the time, the two scores differed by at least 10 points. 14% of the time, they differed by at least 20 points. And 9% of the time, they differed by at least 30 points. So that's almost 1 out of 10 pairs where you're seeing at least a 30-point difference. And then moving up from there, 4% of the time, the two scores differed by at least 50 points.
That's a lot.
Yeah. So in mathematical terms, we observed that the distribution of the two score differences was heavy-tailed, meaning that large differences like 50 or 60 or more occurred more often than you would expect based on just the average or the standard deviation of differences. So yeah, they were often near zero, but they also had more extreme highs and lows than you would see in your typical bell curve.
That's very insightful. Thank you. So what do you believe causes the difference between the scores, knowing, as you mentioned before, Vantage Score 4, and I'm going to say this, you can correct me if I'm wrong, the algorithm used is the same across all three NCRAs. So what do you feel what could cause the difference?
Well, I mean, credit scores are based on the data in a consumer's credit report, including things like number of accounts, amount of credit available, utilization, delinquency history, and so on. And the bureaus or NCRAs have different relationships with different data providers, such as mortgage servicers, for example. What this means is they might learn about new accounts or charges or delinquencies at different times. And so that can lead to timing differences. But even aside from timing differences, the NCRAs can have permanent data differences. For example, due to a competitive market, they each try to acquire new or unique data elements that the other ones don't have. And there can be differences based on just the processing that it takes to get from the trade line data to the inputs that are required for the credit score algorithms. And some models even have slightly different formulas across the bureaus, which isn't the case with Vantage Score 4. So lastly, in some cases, a consumer or a third party may intentionally try to manipulate or hide certain data, like a bankruptcy or a foreclosure, by falsely disputing it or claiming identity theft, for example. And that's called credit washing. And so while that dispute is being resolved, the consumer can qualify for a loan or get a better rate if the loan is based on data from just that bureau where they filed the dispute. So currently this doesn't work for a mortgage because it's hard to wash all three bureaus at the same time, but it can be cause for differences between the bureaus.
Wow, thanks for that insight. I would imagine lenders would be very in tune to credit washing, knowing that, later down the road it could reappear. So based off of your study and the actual data that you guys have been analyzed, what are the implications of moving away from TriMerge, and how could this affect pricing and loan qualification?
Okay, so it's a big question.
Yes.
To analyze it for each consumer, we considered the representative score differences that would result when moving away from the TriMerge standard. Our paper describes the statistics for both a single score framework and a bi-merge framework, but I'll give you a few examples for the single score framework, since it's the one that's been discussed most recently, and I don't want to throw out too many numbers. So note that when choosing a single score randomly, at least a third of the time, you'll get the median itself. So you'll actually get the TriMerge standard. But still, that random choice in our study, the random choice differed from the median by 10 or more points about 14% of the time. And that difference could be either higher or lower than the median. On the other hand, if you consider, what's the furthest single score for a given consumer? What if you choose the outlier score away from the median? Then fully 35% of consumers had at least one score that differed from the median by at least 10 points. Looking at that range, say from 640 to 779, where a consumer could potentially move between those pricing bins that I was mentioning earlier, this actually increased to 40%. And a difference of 10 or more points might not sound like a lot, but we found that in that crucial range from 640 to 779, a score of 10 or more resulted in a move between the 20-point pricing bins, either up or down, about 83% of the time.
Wow.
And then, yeah. So, because it doesn't require a 20-point score difference to move bins. It just kind of depends on where you are.
Where you are within the bin. Yeah.
Where you are within the bin and what that difference is and whether it's higher or lower.
Yeah.
So on the other hand, a 20 plus point difference will always result in a move either up or down to a different pricing bin for consumers in that range. And we found that more than 1/5 of these consumers, or 21%, had at least one score that differed from the median by at least 20 points. So basically guaranteeing that that's going to happen if it's used.
Oh, wow.
Yeah. So you're asking how this could affect pricing and loan qualification. So kind of moving on to that, I want to give a sense of what moving between bins means in sort of practical dollar amounts. So let's consider a mortgage for $350,000 that has an initial loan to value of 90%. To qualify for a GSE mortgage, a loan with an LTV of 90 will usually require PMI, private mortgage insurance, and that cost will also depend on the consumer's representative credit score. So looking at the difference in present value for those PMI payments, depending on where you are, and combining it with the difference in the GSE's LLPA risk fee, moving between 20-point pricing bins can cost between like $3,000 and $5,000 in present value, depending on the underlying credit score. So if you're on the lower end, maybe you're closer to the 5,000. For some changes, you're closer to 3,000. So that, the $3,000 to $5,000 just for moving between consecutive bins.
Yes.
And yeah. So,
yes.
So when it comes to loan qualification, those on the margins could be denied a mortgage if only the lowest score is used.
Right.
And also those on the margins, some of them maybe really can't afford a mortgage, but if the highest score is used, they might end up qualifying and then ultimately having to foreclose. And that's worse than if they just hadn't gotten the loan in the first place.
Wow. That's, again, very insightful. So talking about consumers, I mean, we're down to an example of an anonymous individual consumer. What populations had the largest differences? Because you had mentioned, you had third-party different data. So can you explain to us the populations that you saw the largest differences in your study?
Sure. So first I'll talk about differences based on the credit score. In general, lower scoring consumers had higher variations between scores. So I've already mentioned that for consumers in the 640 to 779 range, score differences, maybe I didn't mention this, but they were a bit larger than for consumers in general. Once you start reaching the higher end where the median is between 780 and 850, there are fewer differences between scores, partly because there is that cap at 850. So you just can't get any higher.
Right.
So for example, I said earlier, 21% of consumers between 640 and 779 had at least one score that differed from the median, either higher or lower by at least 20 points. For those above 780, it was much lower, just 6%. And for those consumers, it also matters less because they're above that top LLPA bucket. And as a group, they have the lowest delinquency rate, so they are lower risk. On the other hand, when you go down in credit score for consumers with scores, say, between 600 and 639, now we're talking about whether or not you qualify for a GSE loan in the first place. And more than a quarter of these consumers, 26%, had at least one score that differed from the median by 20 or more points. In fact, more than 10% had a score that differed by at least 40 points. And that's compared with 7% of consumers in general.
Which is two bands. That would be two bands.
Yeah, you're guaranteeing two bands at that point.
Yeah.
Or you're falling way below or above qualification, where maybe you shouldn't. So that's showing some of the credit score variation. In addition to that, though, there are differences. We saw variation between different minority groups and variation based on household income. And for example, focusing again on those 20 plus point differences, 18% of all consumers had at least one such score. But for a specific minority group, that increased from 18% up to 23%. Whereas for white consumers, it was only 15%. So you're looking at a pretty big difference in like how many consumers have some difference of at least 20 points from the TriMerge median. So moving away from the TriMerge standard would affect different groups in different ways.
Makes sense. Thank you for that. So as we're talking about the single and possible dual bi-merge debate in the industry, can you explain to us what score shopping is and how you analyze that?
Okay, so score shopping is when the lender pulls credit reports from multiple bureaus and picks the consumer's highest credit score to get the lowest fees and the best PMI rate for the consumer. Currently, under the TriMerge standard, it's not possible to do this for a GSE mortgage because all three reports must be pulled and the median score must be used. But there's a lot of competition among lenders to get a consumer's business. So if the TriMerge standard is relaxed, lenders may be incentivized to do this. And even with rules in place to try to prevent lenders from score shopping, consumers who shop around between lenders for the best rate and the lowest fees would implicitly be score shopping themselves. So they would tend to choose a lender that uses their best possible score. To analyze this, we considered metrics around what would happen if the consumer's highest single or bi-merge score is used. How often could the consumer increase their credit score by a given amount over the TriMerge median, and how often would they move up by at least one pricing bin? So we found under a single score framework, consumers in our study, again, in that kind of critical range between 640, 779, they could increase their score by at least 10 points, 22% of the time, and by at least 20 points, 11% of the time. So that's more than 1 out of 10 of these consumers that could achieve a 20-point increase, which guarantees, again, moving up in the pricing grid. However, as we kind of alluded to before, increases of less than 20 can also result in a move up in bins, just depending on where you lie within that bin. So in fact, more than a quarter of consumers in this range, or 26%, could get a better price by score shopping or comparison shopping. Meanwhile, for consumers on the margins of approval, these numbers are even higher. So you potentially have consumers appearing to qualify for loans that they cannot afford.
Which we might find out later, right? If they get the loan in the future. That would be unfortunate.
Right.
Not, I'm sure the consumers would be happy, but it would be unfortunate for possibly the market. How about in your study, you guys have tried to do some real life. Do you see a real life dollar consequence with score shopping? Were you able to articulate a sample on that?
Going back to the previous example that I gave, that sample loan, $350,000 at 90 loan to value. We mentioned that moving between adjacent 20-point pricing bins results in a cost difference of between $3,000 and $5,000 in present value. So now we're talking about that being a savings for the consumer. And of course, jumping more than one bin would roughly double that amount.
Right.
So I should have maybe mentioned that like 4% of the consumers between 640 and 779 could increase their score by 40 or more points, which basically guarantees that move up by 2 bins. And so, on the face of it, to the consumer, this represents a pretty big savings in cost.
Yeah.
To the mortgage insurer and the credit investor, this represents potentially underpriced risk. And if more consumers started to engage in things like credit washing to hide derogatory events, then it could be even worse. So these stakeholders could end up raising loan pricing across the board to offset that risk that, that they need to be compensated for the credit risk that they're taking.
Yes.
And so basically rates could go up across the board. And there could be sort of a feedback thing going on where this even increases the frequency of score shopping even more and sort of locks in less precise credit pricing.
Yes. Or I can imagine some startup company out there helping with the situation, but let's hope not. Along the debate in the industry, we've also seen a number thrown out a few times about, what about doing a cutoff for GSE loans at the 700 score range? So how do you feel about that cutoff based off of your study? Would it eliminate score shopping or?
I don't think so.
You don't think so?
No,
Okay.
I don't think so. So basically this hybrid approach allows the lender to choose a single report framework if the first score pulled is above 700. But if the first score is below 700, then all three reports would be pulled, and all three reports would be used. You'd have the median, so you'd be back to the TriMerge framework for that consumer.
Right.
So aside from consumers between, 700 now and 779, still being able to score shop around for the lender that uses the highest score. There are consumers with median below 700. So their TriMerge standard would be below 700, but the maximum score is above 700. And if that maximum score is the first one pulled, it would become the representative score for the loan. So for consumers like these, there would still be an incentive to score shop. So we looked at how often this could happen. And in our study data set, overall, there were about 100 million scored consumers with a TriMerge median below 700. And of those 100 million consumers, about 6% had a maximum score above 700. And of course, these percentages varied depending on the consumer's underlying credit score. So it was more common for consumers up closer to 700. So looking at the 660 to 679 range, about 8% by using the maximum score could get up above 700. And if you move up to the 680 to 699 range, now we're looking at about 29% of those consumers had a maximum score above 700. And so they would still be able to increase their score through score shopping under this hybrid approach.
So we've talked about a lot. And Joni, you've shown us that the data between the bureaus isn't just slightly different. It can actually lead to significant different outcomes for both the consumer and lenders. If there is one fundamental truth that lenders and investors should keep in mind about credit transparency as the industry evolves, based off of your study, what would it be?
I guess something for everyone involved in the mortgage industry to keep in mind is that when changes are made in the mortgage industry, they tend to remain in effect for many years as the new standard. Mm-hmm. So it's important to get things right, to be cautious and look at all the data and perform a whole bunch of analysis and think through the potential ramifications and the unintended consequences of reducing the data set that's used to qualify and price mortgages. And especially if there's any information asymmetry that's introduced to the system. I think we all have the same goal of ensuring a functioning and fair mortgage market while increasing affordability for consumers and getting consumers into homes and mortgages that they actually can afford. However, those holding the credit risk have an important role to play, and they may require higher compensation for risk if new standards result in pricing uncertainty or adverse selection. And that potentially means higher mortgage rates for everyone. So I guess in short, any changes need to be carefully and thoughtfully considered.
Yeah. Well, luckily you guys were able to conduct a study that I don't believe has ever been done before. So We greatly appreciate your ability to do the study. And let's get an update from our economists at Moody's Analytics.
There's a lot to get to, but let's start in the Middle East. U.S. and Israeli strikes on Iran have sent oil markets into a tailspin. Crude oil prices have surged since the start of the conflict. The Strait of Hormuz, which carries about a fifth of global oil supply, has essentially closed. Our base case is that the disruption is real, but will be relatively short-lived. We expect prices to moderate, but stay above $70 into the latter half of the year before gradually returning to prior levels. But there's about a 10 to 20% chance this gets worse, and in that scenario, oil hits and stays above $100 per barrel. So for American consumers, every $10 increase in the price of oil translates to a roughly 25-cent increase in the price of gas, and every sustained $10 increase leads to an addition of roughly 15 basis points to inflation in the following year. So this is a stagflationary pressure layered on top of what tariffs and tight immigration policy were already doing. So on jobs, February was rough. Payrolls fell by 92,000. The unemployment rate ticked up to 4.4%, and labor force participation hit its lowest level since late 2021. 3-month average job growth is now just 6,000, and the labor market has essentially gone nowhere since the Liberation Day announcements last year. Now, that said, we expect job growth to pick up but remain anemic in the year ahead, with weakness on both the demand and the supply side. So on tariffs, despite the Supreme Court's recent IEEPA ruling, we believe that the administration has enough policy tools to keep the effective tariff rate more or less where it has been. The composition may shift in terms of which trading partners bear the burden, but the macro impact is largely unchanged. So the bottom line is the U.S. economy is still advancing, but the risks are rising swiftly. The longer the Iran conflict persists, the steeper the damage, and that clock is ticking.
Thank you immensely for being our guest on today's Market Pulse podcast. I really enjoyed my time with you, and I hope that we run into each other again in the future.
Yeah, me too. I enjoyed it too. Thank you, Wendy. It's
Thank
great
you,
to
Joni.
be here.
Yes, have a great day. Thank you.
The information and opinions provided in this podcast are intended as general guidance only and are subject to change without notice. The views presented during the podcast are those of the presenter as of the date this podcast was recorded and do not necessarily reflect official positions of Equifax. Investor analysts should direct inquiries using the Contact Us box on the Investor Relations section at Equifax.com.